Bank of Canada's nightmare is your mortgage problem. The bond market is breaking. Yields are surging, not falling, in the middle of a war. The Fed is trapped, the Bank of Canada is trapped, and Trump has painted himself into a corner that he cannot talk his way out of. Today, I'm going to explain what's actually happening, what intervention is likely coming, and what it means for your mortgage. If you're new here, I'm Greg Williamson. I have over 30 years in the mortgage business. This channel exists because I believe that mortgages should be managed, not guessed. Every week, I cut through the noise and give you a clear strategy, not a hedge, an actual call. And right now, things are moving fast, so let's get into it. The bond market is breaking. Let me show you how fast things have changed. Since the Iran war began on February 28th, when the US and Israel assassinated Iran's supreme leader, the US 10-year Treasury yield has surged over 50 basis points, from 3.92 to over 4.45% in just 27 days. The assumption was at the beginning that taking out Khamenei would lead to a very swift regime change, a quick, clean outcome. That's not what happened. We're now 27 days in. Iran has rejected the US 15-point peace plan. Peace talks have completely stalled. It's no longer clear that either side is even looking to end this war quickly. Oil is back to over $100 a barrel, but that's not even the biggest problem anymore. The biggest problem is the bond market. Here's what's strange, and I talked about this in previous videos, but this is critical to understand. Yields are going up during this crisis, not down. The old playbook says when there's a war or there's a big global uncertainty, money flows into US government bonds for safety. That pushes yields down. That's the flight to safety. That's how it's always worked, but that's not happening. Bond investors are demanding a risk premium. They don't trust that governments, especially the US, have their fiscal house in order. So even in a crisis, even during a war, yields are rising. And that's not supposed to happen. And the shift in expectations has been staggering. Go back to late 2025, only 3 months ago. Markets expected the Fed's fund rate to drop to 2.75% as the base case for 2026. There was even a 25% chance rates would go lower than that. Now, look at where we are today. The base case now shows rates unchanged through September 2027, 18 months. That's 75 to 100 basis points above where expectations were just 3 months ago. And it gets worse. Traders are warning that there's a 43% chance that the Fed actually hikes rates by the end of 2026. We went from rate cuts to rate hikes in a matter of weeks. That's not normal. Meanwhile, inflation expectations have surged to 5.2%, the highest since March 2023. Models suggest if oil averages $95 a barrel for 3 months, US CPI inflation will hit 3.2%, maybe higher depending on how long this war drags on. And what happens in the US hits Canada directly. Our bond yields follow theirs. Our rates follow theirs. They always do. This is our problem too. Now, let's talk about the Fed's nightmare and the Bank of Canada's too. Here's what most people don't understand about central banks. The Fed and the Bank of Canada, they primarily control demand-side inflation. They can influence how much people borrow and spend, how much companies borrow and hire, but they cannot control supply-side inflation. They can't produce more oil. They can't end a war. So when you get a supply shock like oil surging to $100 a barrel, they have to overcompensate on the demand side to fight that inflation that's caused by the supply side. That means crushing the economy to offset something they can't actually fix anyway. Right now, models suggest US inflation is heading towards 3.5%, maybe higher if the war drags on. In a vacuum, that means the Fed should hike rates. But here's the problem. The labor market is at its weakest point in years. There's over 2 million jobs that have been revised away from official data since 2019. Unemployment duration just hit a 4-year high. The average person out of work now is unemployed for nearly 26 weeks. That's the highest it's been in 4 years. If they hike now, they trigger a full-blown labor market crisis. If they don't hike, inflation could exceed 3, 4, 5%. They have to choose 3.5 to 4% inflation or 5% plus in unemployment. The Fed is stuck. The Bank of Canada is in the exact same spot. Labor market in Canada is also quite bad. Now, the headlines and traders will tell you central banks have to hike to fight inflation, but I'm not so sure. I think they might choose to tolerate higher temporary inflation over blowing up the economy. Remember what I just said. The central bank's no cuts won't fix the supply side problem anyway. It brings real risk of blowing up the economy, and we still have rising inflation due to oil prices surging. So might they decide that they will not do that? Let's go deeper. This is the Trump corner. What intervention is coming? This is where it gets interesting, and this is where we make the call. Trump has a pattern. Threatens something, markets panic, he reverses course. Markets rally, people call it taco. Trump always chickens out. It worked with tariffs. When the bond market broke during Liberation Day last April, he paused tariffs for 90 days. Crisis averted. We know he watches the bond market because on April 10th last year, he said it in a live interview. He was watching the bond market. And when the 10-year yield hit that 4.5% to 4.7% zone, he blinked. Same thing happened last week on March 23rd. This year at 4:30 in the morning, the 10-year yield hit 4.45%, right below his threshold. 2 hours later, Trump suddenly announced productive talks with Iran and postponed strikes on Iranian power plants for 5 days. That's not a coincidence. That's him intervening in the market. But here's the problem this time. His old playbook doesn't work. You can't assassinate a supreme leader. You can't just tweet, hey, war's over, and have Iran accept it. They've already rejected his 15-point peace plan. The war has physical momentum. Troops are deployed. Strikes are happening. Iran is just not Iraq. They are in this for the long haul. And frankly, depending on how you look at it, they might be winning. Their strategy from the beginning is to wage their attacks on the global market. And as we are discussing, that is clearly working. Trump has painted himself into a corner and the bond market knows it. So let's go through what are his options. Option 1, keep trying to negotiate. He's doing this right now. Productive talks, postponed strikes. He's trying to calm the markets. But Iran isn't biting. And every day the war continues, oil stays elevated, inflation expectations rise, and yields keep pushing higher. Not to mention the problem Trump has that he says, no more strikes for 5 days, and then Israel goes and bombs 2 power plant facilities in Iran. The market thinks Trump is either full of shit or he can't control Israel. Either way, it means he is quickly losing any leverage that he had. Option 2, he could escalate to force a deal. Trump's instinct is to dominate. The press secretary just said this 2 days ago. Shock and awe, massive escalation, bomb the hell out of them to force Iran to the table. The problem? Iran has shown it won't capitulate easily. Escalation could spike oil to $120, $150 temporarily, and there's a real risk that that plan backfires badly, and Iran knows it. They are essentially egging him on because they know any escalation will push the yields way past Trump's comfort zone. I don't think this is the likely path, but I can't rule it out. Option 3, yield curve control. This is the big one, and I think this is where we're headed if yields keep rising. Here's what yield curve control means. The Fed caps the yields at a specific level, which would probably be around 4.5%, their comfort zone, on the 10-year, and then they buy unlimited bonds to enforce that cap. It's essentially money printing to suppress rates. This will be an enormous amount of money printing. And yes, you probably caught this. It's a giant Ponzi scheme that the people pay for. Print money out of thin air, which hurts all the people with inflation and devaluing their dollars to buy their own bonds. This is just insanity. But why might this happen? Currently, bond auctions are already showing very weak demand. There's a staggering amount of government debt that needs to be refinanced this year. If yields hit 4.7% or 5% or worse, everything breaks. The government can't fund itself at those rates. They literally approach insolvency, and the US can't let that happen. And frankly, we don't want that to happen either, because then the real pain comes. Yield curve control is the break glass in case of emergency tool. We've seen Trump's policy shift zone. That's 4.5% to 4.7% range on the 10-year. Every time yields approach that zone, he intervenes. He pauses tariffs. He announces peace talks. He does something. If yields push into that zone again and stay there, I believe we're going to see yield curve control or something like it. They'll probably call it something different, and they'll probably make it sound like they're buying their own bonds, but it's the same thing. Print money, suppress the yields. But here's the catch. Yield curve control is highly inflationary. You're printing money out of thin air to buy your own bonds. You're suppressing rates artificially. Short term, it'll stabilize the market. Fixed mortgage rates might even come down temporarily, but long term, inflation runs way hotter, and this time hotter than ever. We're not solving the problem. We're choosing to averting a market crisis now versus an inflation crisis later. Kick the can down the road. And central banks will probably choose the later. They always do. Remember COVID? They printed money to force yields down and rates went to the floor. Then only 2 years later, the rates moonshotted to 6%. This pattern is repeating itself right now. Only the money printing this time that they'll need to do will dwarf what they did in COVID. What does this mean for Canada? And the Bank of Canada will always follow whatever the Fed does. We always do. Our economies are too linked. If yield curve control happens in the US, expect similar moves here. It's kind of already happening. The Bank of Canada has already been buying some bonds. Rates stabilize in the short term, but inflation stays elevated, and the uncertainty does not go away. It just changes shape. Here's my call for this week. The only call that makes sense is a fixed mortgage with a relock. So the bond market's breaking. Central banks are trapped. Trump is cornered. Intervention is likely. But all of this is highly inflationary, and we have a very small window. And you, as a mortgage holder, you need to play this right. Both fixed and variable rates could go up from here. That's the scary truth. But here's what I believe. This is exactly why our program with fixed with a penalty protection is the only strategy that makes sense right now. Let me explain. If yields keep rising and fixed mortgage rates go up, you'll be glad you locked in when you did. If you have a mortgage coming due later this year, you should look at renewing early. Renew now, not in November, because things will be a lot different. If intervention breaks yields down and fixed rates drop, our penalty relock program lets you capture that lower rate. We start with a lower penalty on mortgages to begin with, but then we split that penalty with you 50-50, up to $5,000. Anything over $5,000, and you're capped. We cover all of the rest. So you're not betting on which way this breaks. You're protected either way. Variable right now is a bet, and it's a bit risky. It's betting that the Bank of Canada stays frozen, and the war ends quickly, and inflation stays contained, and intervention doesn't spark more inflation later. That's way too many ands. The spread between fixed and variable is only about a quarter point. That's not enough of a cushion for the risk that you're taking. Lock in the fixed, get the certainty, and work with someone who can help you relock 12, 14, 18, 36 months from now when the world changes again. That's a managed mortgage, and that's what we do. Look, we're in uncharted territory. War, inflation, bond markets breaking, labor markets collapsing, central banks trapped, AI is taking jobs. We have a president who can't talk his way out of anything right now. He can't talk his way out of this one. And I don't exactly know where this resolves. Nobody does. But I do know that fixed with an escape hatch is the right move when uncertainty is this high. If you want to help navigate this, click the link in the description or the pinned comment to book a call. See you next week.